Okay, let's try to get started tonight. We'll go for a second time. I know that missing the second week of class because of the flu is not really good timing. I really didn't have a choice, okay? Believe me, you didn't want me here last week. But I will tell you, when you see all of these public service announcements about washing your hands and using hand sanitizer and all of that, take it seriously, okay? Last week was a rough week for me. There were some days when just sitting up in bed, that was my major accomplishment for the day, okay? So it was not a good time. But I'm pretty much recovered. I've still got a cough, so I'll try to stay away from you as much as possible. But tonight, a couple things I want to talk about before we're going to kind of jump around a little bit tonight. We're going to spend just a little bit of time in chapter 1. We're going to spend just a little bit of time in chapter 2. Some of that's going to be left up to your reading, especially chapter 2, because it's basically about a lot of different regulations, and you can read about those as easy as I can talk about them. But what I've passed around for any of you, and I know it's kind of hard to get a feel from having one class and then missing a week, but this is our, and I've been talking to a lot of students about this, our newest major in finance. It's the area in finance with the commercial bank management option. And essentially this walks you through the classes necessary. So you'll notice there's no additional hours required from a traditional finance degree. The hours that would typically be finance electives are taken up with mandatory banking type classes. Also, one thing that's not in there that you can include in where it says required specialty courses would be Finance 505, which is the internship in finance. You could substitute that in for one of either the Finance 344, 354, or excuse me, Finance 350. So again, that's just something that as you're kind of looking at your future, if you're thinking, I may want to talk about this, I want to talk about careers, that type of thing, then feel free to come see me. The what? The required courses, yeah. Instead of having the 15 hours of finance electives like you would with just a traditional finance degree, they're pretty much taken up with most of those classes. Still do that in what? That's a good question. I don't know. If you want to take those extra courses, you technically could, I would guess. Yeah, but typically with the CFP, all the finance electives that you would have had are the CFP classes. So when it comes to, for example, Accounting 302, Finance 336, 338, all of those, if just a straight finance degree, you just got 15 hours of finance electives, any finance class you want to take. With the CFP, they tell you which classes you need to take, and with that, it gives you the classes that you need to take. Okay, a couple of other things. One is on Canvas. If any of you are looking for a part-time job, I posted a couple of jobs earlier today. If you go to the announcements section, so there were had a couple people contact me today. One was Signet Credit Union, and basically they're looking for some part-time tellers in Mayfield, Paducah, and in Murray. So there's the contact information there. Also, the Murray Bank is looking for some people, although I think they may have their positions filled right now. But if you're interested there, that is where you would send your resume and your class schedule. Also, one other thing that I want to point out is the career fair. So if you go to here to employment information, there's going to be a letter here on the career fair, the spring 2017 career fair, and then there are some workshops in advance. So it talks about how to dress, how to act, how to put your resume together, your cover letter together, that type of thing. So you can you can click on these links and take a look at this. So again, just I'm trying to kind of fill in as we go along. Now, after, let's say we've met the first week, are there any questions about, we went over just the syllabus, the test, the paper that's due, which is a ways off, so I know you're not worried about that right now, not too many of you. Are there any questions about anything before we jump into chapter 1 tonight? Okay, the syllabus is on Canvas. So if you go there, the very top line of the Canvas, I didn't pass them out in class. You can take a look at it. Okay. All right, other questions before we actually start talking about banking in week 3? All right. Okay, now, chapter 1 basically is just like with any other type of class. It's kind of an introductory chapter. It just talks about pretty much about banking, the history of banking, what's happening. And what you'll notice is that as we go through and we talk about banks and banking and the process of being a banker, that's kind of what I want you to do as we go through the semester because typically when we think about banking, we think about it from the standpoint of the customer. So you're the bank customer. You're making deposits into your checking account. You're borrowing money from the bank, whatever it might be. But I want you to change that around some and start thinking about banking in terms of you running the bank. So we're looking at things in terms of, okay, we're going to make loans. We're going to make credit decisions. We're going to take a look at asset liability management. We're going to look at bank financial statements to determine how is our bank doing financially when we go through the different ratios and the different types of analysis. Now, banks have been around a long time, okay? So you're going to have a very brief history of banking. They've been around for about 2,000 years. And the way banking got started was essentially, if you think back 2,000 years ago, there were lots of different small towns and lots of different forms of currency. And currency tended to be very heavy. So they didn't have paper currency. It was metal and it was heavy. So if you were going, let's say from, you're a business owner, so you're going to another town to purchase merchandise for your business. You go to that town. When you're going in, typically outside of the town, there's going to be something called a safekeeper or a money changer. And each little town, so you can imagine if Mayfield had its own currency and Murray had its own currency and Paducah had its own currency. So every time you went to one of these towns, you had to exchange your money, your Murray money, for Mayfield currency or Paducah currency. Well, that's what they had to do. So they would stop at these places outside of town. They would exchange some currency. Now, again, currency was pretty heavy, and so what they just typically started doing was the safekeepers, they would simply give the person an IOU. They're saying, okay, you've got so much money. Instead of taking it into town, risk it being stolen, I'm going to change it to our currency, then I'm going to keep it here and keep it safe for you. Here's an IOU. When you need it back, just come back, and we'll give you your money back. So, now, again, when the business people would go into town, they would buy whatever they needed, but instead of having to travel back to the outskirts of town to pick up their currency and then go back into town to pay for it, the shopkeepers would just accept the IOU. So it said, you've got so much money deposited with the safekeeper, and they would hand that to them, and they say, okay, this is good enough. And what happened was, essentially, those paper IOUs started being traded around town as paper currency. Now, the safekeepers who had the currency, they were looking at this and they thought, you know what? I've got all of this money that I'm holding on for people. And very rarely does somebody ever come take their money. I mean, occasionally, yes, somebody will come in and present me with the IOU and they'll take their hard currency. But most of the time, they never come get it. So since I'm holding on to it, why don't I just loan it out I can make a little money on interest. I can also make money exchanging the currency and keeping it safe. And if somebody comes and gets it, as long as everybody doesn't come at once, I'm okay. And so they started making loans using what's called a fractional reserve system. They would loan out a fraction of what they had. And again, as long as everybody didn't come at once to get their money, they were okay. And so this went on for just hundreds and hundreds and hundreds of years. And there wasn't a lot of difference, wasn't a lot of change in banking. Now, if any of you have ever watched old Western movies where banks are being robbed, it seems like almost on a daily basis. Okay? First of all, that is not true of the Old West. It seems like every bank was getting robbed every week. There were very, very few bank robberies in the 1800s in the West. Okay? So that's just in movies. But if a bank was robbed before 1934, there was nothing that would secure your deposits. There was an FDIC insurance, and now you see it everywhere. If you go into your bank, you see FDIC insured up to $250,000. But before 1934, that wasn't available. So if somebody walked into your bank and took money out of your bank and they took your money, unless you went and physically took it back, you don't get your money back. And so that was a big problem with banks for lots of years. So when FDIC insurance went into effect on January 1st, 1934, this was a huge benefit, not only to banks, but to customers, because you could rest a little bit easier at night. Because up until that point, we had things like the Great Depression, which a lot of people lost their money in banks, and banks weren't trusted. I mean, I know today you may think, I don't trust banks, and I'm not sure quite what they're doing. But before this, it was a huge problem. And people would rather put their money in their mattress, bury it in the backyard. I mean, that was very, very common. And occasionally today, you still find stories, you still hear stories of people, they'll run across a metal box or a glass jar full of money buried in a yard somewhere, and it was buried 80 years ago, 90 years ago by somebody who did not trust banks. Now, we've got our FDIC insurance. It was $100,000 for many, many years. Then it jumped up to $250,000. So what that does is it protects you in case your bank fails. It protects you in case somebody robs your bank. Basically, it gives you, as a customer, peace of mind that when you put money in your bank, it's going to be there. Okay? And that is a huge benefit to our banking system. Now, there were some other attempts at banking. For example, the United States Postal System had their own bank. It was called the USPSS, the United States Postal Savings System. And basically what that did is there was a problem with people who lived in rural areas like Western Kentucky not having access to banks. And so the postal system decided, and politicians decided, that if we would simply allow post offices to serve at banks, there's a post office in every tiny town. I mean, there might be 50 people in the town, but it's going to have a post office. And so that post office could serve as a bank to people in rural communities. Now, they started talking about this in 1871. And this goes back, and there's a lot of back and forth between different politicians in terms of the politicians who lived in cities, the capitalists, versus the agrarian society, so the farmers. And there was a lot of back and forth over this. It finally went into effect in 1910. As a matter of fact, they wanted to pass a law where if you wanted to deposit money in your bank, you would simply hand it to your postal carrier, and your postal carrier would then take your money and make the deposit at the post office. Now, I don't know about your postal carriers, but sometimes I do pretty well with mine just to get my mail. So I don't know if I want to leave cash money in the mailbox so that they can pick it up and then take it and deposit it. But again, they thought maybe we shouldn't do that, and so that was not officially passed. This was in effect until 1966. It was officially abolished. And also one other thing that occurred frequently before FDIC insurance was a run on a bank. What this simply means is if there was the slightest hint of a problem at the local bank, and we know that there's what's called a fractional reserve system, which means that a bank keeps a fraction of your deposits in the bank itself, in the vault, or on deposit with the Fed. The rest of it is loaned out. Well, people understand that, and they know, look, all of our money is not at the bank at any one time. So if we think the bank's going to close, or we think the bank's going to shut down because of illegal actions or whatever it might be, they rush to the bank. They would literally run to the bank and try to take their money out as soon as possible. And if you were one of the first few in line, guess what? You got your money. If you were one of the ones further back in line, they didn't have your money. Now, you can imagine how happy people were when they get up to the teller window and they say, I would like to withdraw my $500, and so they say, I'm sorry, we don't have your money. How do you think people reacted to that? You don't want to be the banker telling them that, okay? And so bank runs was common, but again, because of FDIC insurance, the bank runs, they kind of just took care of themselves. And so today, if we hear that, for example, our bank has been robbed, or if there's a rumor going around that our bank might shut down, does it concern us? Yeah, it does. Do we rush down to the bank to take our money out? Probably not, because we know FDIC insurance and we know that the money is safe. And this system is set up such that if a bank fails, it's going to close on a Friday, sometimes even a Saturday. Everything's going to take place, all the changeover is going to take place, and Monday morning that bank is going to open, and you as a customer probably aren't going to notice a difference in what's happening at your bank. Okay? So this is just kind of a quick history of banks and banking. Now, basically what banks do, and again, there's some of this information I'm going to jump through pretty quick. Some of it we'll spend a little more time on. It tells us here banks are a principal source of credit, which is loanable funds, for millions of individuals, families, businesses, etc. Banks grant a lot of installment loans. So car loans, boat loans, motorcycle loans, that type of thing. This is a huge business and a huge moneymaker for banks. And if you take a look at this, and this doesn't really change a lot, although it's changed a little bit over the last few years, it says that the assets held by banks represent about 20% of the total assets in the United States. So 1/5 of all assets are controlled by banks. That means that banks are a big player in the financial industry. And they have a lot of power. They have a lot of clout. We'll go back and talk later in the semester about our financial collapse in 2008. And you can see basically how close the United States was to just a financial disaster. Because if the banking system shuts down, or if people decide the banking system is not trustworthy, as we look at what banks do and you get a feel for just how much power banks have, you'll see if that happens, the rest of the economy is going to shut down right behind it. So there's a lot of risk involved, and there's a really good reason why politicians want to make sure that banks stay open. Now, there's also another good argument for if banks make bad business decisions, they should close. Because if I've got a textbook company and I misprice my textbooks, or if I don't advertise correctly, or if I make some bad marketing decisions or bad purchasing decisions and I go bankrupt, is the government going to step in and save my textbook company? No. I mean, tens of thousands of businesses close every single year. But in the banking industry, and again, we'll talk about this later in the semester, but there's something called banks that are too big to fail. And what that simply means is some banks are so large that if they did shut down, it would cripple the economy to the point where we might not recover, or we might not recover fast enough, and it would have a ripple effect throughout the economy. So it's pretty nice if you're one of those banks that's too big to fail. Because what that means is you can make as many bad decisions as you want, and you can't close. So that's pretty nice if you're the banker running that particular bank. Okay, now when it comes to a bank and trying to define a bank, this is constantly changing. There's lots of different definitions for banks. It says here a bank can be defined in terms of the economic function it performs, the services it offers its customers, the legal basis for its existence. Just lots of different ways that we can define a bank, and this has changed a lot really over the last 30 years. Banking went for hundreds of years. It didn't change much. And then the last 30 years, there's just been tremendous changes in the banking industry. Now, to get down to the actual definition of a bank, let's look first at some different types of banks. Okay, I understand this is small print here, but all of these fall in the category of banks. Commercial banks, money center banks, community banks, investment banks, merchant banks, international banks, wholesale banks, resale banks, minority banks, national banks, state banks, insured, uninsured, member, affiliated, virtual bank. You can see there are lots of different definitions for a bank and what a bank does. And each of these does something just slightly different. Now, in looking at some of the different types of banks, and we'll take a closer look at these as the semester goes along. But in terms of money center banks versus community banks, this is really where a big gap appears in the banking industry. You've got your really big banks, and you've got your really small banks. The big banks are called money center banks. So these are your Citi banks, your JP Morgan Chase, your really big banks that do business worldwide. Then you've got your community banks. So these are the banks like locally here, the Murray Bank, CFSB, FNB. These are your smaller banks. They do a lot of the same services as the big banks. They perform a lot of the same services, but they just have different customers. They have different roles that they play in the community. They're treated a lot like some of the bigger banks, but they probably shouldn't be. And so we'll talk when we talk about regulations some, we'll discuss that a little bit. Now, this is the definition of a bank, okay? So you need to know this definition. This is as close as I can get, at least for 2017, to the definition of a bank. It says a bank is any business offering deposits subject to withdrawal. So those are, for lack of a better term, checking accounts on demand, and making loans of a commercial or business nature. So if a business offers demand deposit accounts and it offers business loans, it qualifies as a bank in 2017. Now again, if you go back to that big list that we just looked at, of course they can do other things also, but they have to do these two things. You can see here that there's a little different definition. It says Congress has further defined a bank as any institution that could qualify for deposit insurance administered by the FDIC. Now, what you're going to see over the next at least 4 years. By the way, just in case you haven't noticed or didn't hear, we had a little thing called a presidential election back in November. And there's going to be a lot of changes in a lot of industries. The banking industry is one of those. Because for a lot of years, banks have been under extreme, we'll talk about this in a minute, but extremely heavy regulatory burden. There have been lots and lots of laws and regulations for banks. Now, with good reason, because again, banks are important, and if you don't heavily regulate banks, you don't want them doing things that are illegal or that might lose your deposit money. Well, you're going to see, I think, a lot of that regulation being peeled back over the next at least 4 years. Now, is that a good thing or a bad thing? Well, I can't really say if it's good or bad. Banks are going to think it's a great thing because they're going to have less regulation to adhere to, and regulation is expensive. We've got a bank here in town. It's about probably a $600 million bank, I would guess. And when you take a look at banks, and we look at banks' ratios, for example, the return on assets of a bank, a lot of people think banks make a lot of money. They don't make a lot of money. If a bank has a ROA, a return on asset, of 1%, it's doing pretty good. And so if you've got a $600 million bank, what is 1% of $600 million? $6 million. Okay? So if you're making $6 million in profit on $600 million in assets, you're doing pretty good. Now, that bank, that $600 million bank, I asked their CEO in the next class behind this one, the Finance 537 class, I bring in a lot of different speakers. So I bring in a lot of bank presidents, a lot of commercial lenders, consumer lenders, compliance officers, regulators, and they basically talk to you about their careers, what they're like, that type of thing, to give you a better feel for the banking industry. And I asked the CEO, I guess this was last year, how much they spent on complying with regulations. And they estimated they spent a little over $1 million per year just complying with all of the regulations that are out there for their bank. So if you look at that, that is, if it's a $600 million bank and they make $6 million per year, their income could go up by another almost $1 million if they didn't have to comply with so many regulations. So it's really, really expensive, and typically it hits the small banks the hardest, simply because with the small bank, how many people in here work for a bank? I know a few of you do. So some of you work for smaller banks or credit unions. You know that you're spread pretty thin. Most of the time, one person doesn't just do one thing. One person does a half dozen different jobs. And the regulation that we have piled on banks, that simply makes your jobs a little more difficult. So again, lots of regulations, but this is what we're going to stick with as the definition of a bank to this point. Okay, let's see. Some of this I will skip through. Okay, one thing, and I'll just kind of summarize this. One thing that a bank does, and it does it very well, is a bank brings together those with excess money and those who need to borrow money. Okay, so a bank is called, when you take your money and you deposit your money in a bank, you are letting that bank become what's called a delegated monitor of your money. You're simply saying, here's my cash, take it, do with it what you want, but when I come back to get it, I want to be able to get my money back. Now, when that bank takes your money, they don't just take it and hide it in the vault somewhere. A lot of people mistakenly think that if you go into a bank vault, like in the movies, you're going to see cash just laying everywhere. There's just $100 bills stacked everywhere, and the bankers, after the bank closes, they just go in the vault and they roll around in the money and just, it's like you might see in a movie. Well, first of all, money is the thing you ever touch in your life. You don't want to roll around in stacks of money. Matter of fact, they did a study a few years ago, and they tested bills, paper bills, $100 bills, $20 bills. You would not believe the stuff that they found, it's stuff that you probably touch every single day on a $20 bill. There's something like 10% of the money that they tested had traces of cocaine on it. So 1 out of 10 $20 bills has traces of cocaine on it that you'll never know. Okay? So it is just some really, really nasty stuff. But again, banks don't keep a lot of cash on hand. And so you know that if you need to borrow money, and college students tend to be net borrowers of money, instead of walking around asking people, hey, do you have some money I can borrow, you simply go to your local bank. Now, let's say that I have a little more money than I might need. And I have access to 40 college students who tend to be borrowers. Now, one thing that I could do if I think my bank is not paying enough interest, because if I take my money to the bank right now, they're going to pay me about, well, less than 1% interest. And I'm thinking, that's not very much. But if you go borrow money from your bank and you want, for example, an unsecured loan, they're going to charge you probably 10, 11, 12%, something like that on an unsecured personal loan. So maybe I get the bright idea, look, they're going to pay me 1%. They're going to charge you 12%. Why don't I just loan out my own money? And we both win. So I come in here in class and I'll write down, $1,000 to loan out. See Dr. Lacewell. I put my email address up there, my phone number, whatever. And so one of you comes to see me, you say, hey, I need to borrow $1,000. So we talk about it. I say, well, okay, what was the bank going to charge you? 12%. What were they going to pay me? 1%. Why don't we kind of split it down the middle, and I'll charge you 6% interest. You can borrow my $1,000. So I'm winning. I'm getting more interest. You're winning. You're paying less interest. And we can just do without this silly banking system completely. Who needs them anyway? We don't need them. Now, what problems can you see happening in that situation? The what? Not paying me back. I mean, first of all, that would not be a good decision, okay? But, do people actually not pay their loans back? Seriously? Oh my, yeah. People will sit across from you. They will sit here. They will look you in the eye, and they will say, I will never, ever miss a loan payment. And guess what? They missed the first loan payment. I mean, I know it's hard to believe. You're young. World's kind of a perfect place. People will lie to you, okay? And so they don't pay you back. What if somebody doesn't pay me back? What can I do? I'm walking around here. Somebody's got my $1,000. I mean, I hope it's nobody in this class because you all look like honest people. But what remedies do I have if somebody doesn't pay me back? What if I've only got $1,000 to loan, though? Wow, that's tough. Okay, so I've lost my money here. Okay, so I could say, hey, you stole my money. Let's say I've got a signed contract with you that says you're going to borrow my money, you're going to pay it back on this date, you're going to pay me interest at 6%. So I've got this nice signed document. Well, that's great. But what if I can't find you? What if you leave town? That's an option, okay? You could hire a hitman. But it's $1,000. Okay? I don't know how many hitmen you've hired in the past, but they're going to cost more than $1,000. Even taking it to small claims court is going to cost more than $1,000. So I've loaned you the money, but it's not really worth my while to try to get it back. So if I make one mistake, my money's gone. So that's one issue. What's another problem? Okay, so I could maybe loan $100 out to 10 different people. That's my $1,000. But now I have taken my risk. And what concept do we call that in finance? Diversification. So I've diversified. I've spread my risk out. And maybe out of those 10 people, maybe one person might not pay me back, but the other 9 will. That's kind of how our banking system actually works. Because we know that for all the car loans and boat loans and credit card loans and everything, all the loans that are made, we know that some of those simply aren't paid back. And to compensate for that, the bank has to charge you, when you borrow money, they have to charge you a higher rate of interest. That's why credit cards, we'll talk about credit cards towards the end of the semester, but credit cards tend to have the highest interest rates, and that's for a couple of reasons. One is the default rate on credit cards is really high. A lot of people don't pay them back. And secondly, they're unsecured, so there's no type of collateral that you can take and sell if somebody doesn't make their credit card payment. Unlike, for example, a car loan. If you get a car loan, the car is used as collateral. Somebody doesn't pay the bank back, then they can legally repossess the car and sell it and try to get some, if not all, of the money back. Typically, they don't get all of their money back. Okay, so banks bring people together who need money and who have excess money. So do we need banks? Yeah, we kind of do. I mean, sure, I can loan money out myself. I could give it a shot. I probably wouldn't do it for very long because it's simply not worth 6% interest on $1,000 for all the headaches that are involved. So we simply take our money to the bank and we say, here you go, here's my $1,000 deposit. You decide who to loan the money to. You decide if this person does need a loan, they don't need a loan. What are the terms of the loan? What's their credit history look like? What are the payments? When are the payments going to be made? Who's going to call them if the payment is late? All of that stuff is a huge headache. I told you I used to be a regulator and then I was a loan officer for a while, commercial loans and consumer loans. And I can tell you, and we'll talk about some of these stories as we go through the semester, but when it comes to people and money, you would not believe some of the situations that banks get themselves into and borrowers get themselves into. I'm talking really messy, nasty situations. There used to be a lot of shows on television about repossessing planes, boats, cars, whatever. I don't see as many anymore. But, I mean, that's a big business. If you're a big bank, you can, and if you're good at repossessing and tracking people, you can make a lot of money repoing assets for lenders. Now, if you're a small bank, like the banks that I work for, and you make a bad loan, guess who repossesses the vehicle? The person who made the loan. So I'm the one going out there and repossessing the car or the truck or the tractor or the herd of cattle or whatever it is that you made a loan on that you have to now go take back. As a matter of fact, it's even worse if you're collecting loans that were made before you got there. I remember one couple, and this was, I think they were not, I'm trying to think, they weren't married at the time. It was a husband and wife, and they were in all types of legal problems. But the husband, the ex-husband, had co-signed on the wife's loan for a van, for a panel, for like a custom type van, you know, the kind that's the carpeting inside and the windows and all of this. And so the guy that ran the bank before me, he had made a loan to this woman for this van for some reason. He left. I inherited it. I had to go repossess it. And so I took somebody else from the bank with me to drive the van back. I could tell as soon as I pulled up to the house, which was in a really bad part of town, the van wasn't going to be going anywhere. It had 4 flat tires. It had one of the windows kicked out. They had taken a piece of plexiglass and glued it to the side of the van. So it's the first time I'd ever seen the van. So I'm looking at it going, and they owed like $4,000 on it. It was probably worth $500 at most. And I'm thinking, this is probably not going to turn out very well. Now, at the time, there was, and this was up in central Illinois, there was this was in Decatur, Illinois, there was a Firestone plant, Firestone Tires, and they were on strike at the time. And so the guy that I was repossessing the van from, his wife was in jail at the time for some type of drug possession charge. I'm going to see him because he was a co-signer. I'm trying to get the keys from him, so I knock on the door, and you have to see this guy. This guy was huge. He was about 6'7". He probably weighed 300 pounds. He was always nice to me, but I'm knocking on the door, and he's not coming to the door. So I hear something behind the house. So I'm in my suit and tie. I'm at this kind of rundown house. So I step around the back, and there's this guy and 2 of his buddies, and apparently they've been drinking beer all afternoon. They had the nicest pyramid of empty beer cans I'd ever seen on a picnic table in the backyard. They were all just as drunk as they could be. Now, you've got to put yourself in my place. I'm the evil banker coming to take their van. He's on strike and has a very, very small source of income coming in. And I'm dealing with these 3 giant drunk guys. Now, that's not the situation you want to see yourself in. So I thought, okay, I've got 2 options here. One option, I can get in my car and I can leave. That was probably the better option. But I decided, okay, now I'm going to go talk to this guy. So I thought it'd be better if I separated him. So his name was Doug. I said, Doug, hey, can I talk to you for a minute? So you can just imagine he's kind of in a drunk fog. He sees me coming around the corner of his house. He's like, what the hell's going on here? But I separated him from his buddies. I got him in the house, and I said, hey, I hate to do this. You know your wife, your ex-wife, you co-signed on her loan. That van is way past due. I was going to take it, but I can't drive it. I'm going to have a wrecker come and pick it up and get it. But do you have the keys to it? And so this is where, I'm expecting the worst to happen. Well, you've got drunks that are mean drunks. You've got drunks that are really nice drunks. This guy, luckily for me, was a really nice drunk. So he's just like, sure, that's fine. And he had some pretty choice words to say about his ex-wife. I've got the keys here. I'll give them to you. If you can get that thing out of the driveway, please do. And so I got the keys. I left really quickly and sent a wrecker back later to pick up that piece of crap van and actually had it towed to the junkyard for scrap metal. Now, that was a situation where you think, well, that's kind of funny. You got these 3 guys in the backyard. They've been drinking all day. They're out of work, whatever. But if you think about it, those types of situations, one thing goes wrong, and it gets really messy really fast. And so what I can tell you is today, most banks don't repossess their own assets for that very reason. Is because there were people who got hurt pretty badly doing this. You've got to have professionals who know what they're doing. Some people will happily give you the asset. Others are going to run from you and hide it until the very end. They're going to keep whatever it is. They're going to hide it until they have to give it back to you. So there's lots of situations like that when you get into this, okay, this is what a bank does. This is how a bank makes money. Well, there's a lot of things outside of what you find in a textbook in the banking industry that they're not going to tell you about as you read through your nice, neat bank textbook. Okay, now competition for banks. What you will find is that banks have lots of competitors, and this statement at the bottom of the slide here is pretty telling about banking. It says, perhaps banks are being regulated to death. name some competitors for banks. So what are some examples of competitors that banks face every single day? Insurance companies, yeah. You can go to your insurance, you can go to State Farm. You can walk in, you can borrow money to buy whatever you're buying. They can also provide you with insurance for that asset. They can sell you life insurance. They can sell you some type of insurance to cover your loan in case you get hurt. I mean, it's kind of like one-stop shopping. Previously, we didn't have to worry about that. Banks made loans, insurance companies sold insurance. But now it's completely different. So that's a really good example. What's another example of a competitor for a bank? What about credit unions? A lot of people, when they think about credit unions and banks, they think it's the same thing. Well, it's actually not the same thing. Credit unions they're run by their members. Okay, banks are run for profit. Credit unions are run for the benefit of the members. And so credit unions are what's called a not-for-profit institution. Now, if you're a not-for-profit institution, the big benefit to that is you don't pay income tax. Banks are, again, for-profit institutions. Banks are corporations. Banks pay corporate income tax. So if you're a bank, and let's say you're paying taxes at 30% rate, and you're trying to make a loan to someone in a credit union that doesn't pay income tax, they're trying to make the same loan, who do you think can offer the best terms, which means the lowest interest rate on that loan? Typically, the credit union. And when it comes to savings accounts and deposit accounts, who do you think typically can offer a higher rate of interest on your deposit accounts? Credit unions. But for the average person who hasn't sat through a bank class, they walk into a credit union and they look around, it looks just like a bank. There's a line of tellers, there's a customer service representative, there's a loan officer. What difference does it make to me if I'm getting the best deal on my loans and my deposits? I don't care whether you call it a bank or credit union, a savings and loan. It doesn't matter to me. But for credit unions to work, though, the key here is there has to be some type of what we call a common bond between the members. So all of the members have to work at the same place, or they have to live in the same county. So if you, for example, the Murray State University has the Murray State University Federal Credit Union. So if you work for Murray State, or if you're retired from Murray State, you can join the MSU Federal Credit Union. Now, there's one odd thing that I've noticed about the credit union, one group of people that you would think would be a natural for the credit union that can't join it. What group of people do you think that is? Murray State students. That's always been a really strange thing to me. You've got the Murray State Federal Credit Union, but Murray State students can't join. Now, there's some reasons for that. Murray State students are expected to be here approximately how long? Typically, hopefully 4 years, maybe 5 years. You start getting into the 6 or 7 year plan, especially if you're not paying for it, people get worried. So they tend to be a transient group. But if you look at banks, banks really want your business. Now, there's only one Murray State Federal Credit Union. So when you leave Murray, you're not really going to be dealing with the Murray State Federal Credit Union much anymore. But if you're a customer of, let's say, Regions Bank, and you leave Murray and you move to Birmingham, Alabama, or Nashville, Tennessee, or Memphis, or just about anywhere in the Southeast, there is going to be a Regions branch there who can take care of you. And so what banks do with college students, banks love college students because they know that right now, most of you don't have a lot of money. But eventually, they're grooming you. So if they're really nice to you when you first start to college and you stick with them, then when you start having lots of money and you start borrowing money for cars and boats and motorcycles, they want to keep you as a customer. So they know they may lose some money on you as a college student, but they're going to more than make up for that once you finish college and you start working, making some money. And one of the things that banks do, and we'll talk about this in Chapter 5 when we get to types of what's called non-interest income, but a lot of college students, not every college student, but some college students write bad checks. So you write a check, you don't have enough money in your account to cover it, and you're going to get what's called an NSF fee. That stands for non-sufficient funds. And that's going to run anywhere from $25 to $40. And when I was a college student myself, I used to think, man, banks must hated people write bad checks. It's just got to be so embarrassing, and banks just must really not like these people as customers. I can tell you, banks love it when you write a bad check because they're making $30 to $40 for basically covering your bad check for 1, 2, maybe 3 days. So they're loaning you their money temporarily. You're paying $30 essentially they don't call it interest, they call it a fee, but it's essentially interest to use their money for a day or two until you can put money into your account to cover the bad check. That's a huge money maker for banks. And they want you to write all the bad checks you can as long as you can make it right. As long as you've got the money that you can eventually put in there to make your account right and have a positive balance, they don't care at all. Okay? That is a huge money maker for banks. All right, so some more competitors. You know, we talked about credit unions, mutual funds, hedge funds, investment banks, finance companies, insurance companies, just lots and lots of competitors. And this is one reason that banks, which used to be a really, really profitable endeavor for a lot of people, because of competition, banks, their margins, and we'll talk about margins in Chapter 5 and Chapter 6, but their net interest margin is being squeezed to death because of all the competition, and so now they're looking for more ways that are not interest related to make a profit. For example, NSF checks, other fees that they can possibly charge. So in looking at this, I mean, you could go to just about any of these types of companies and they can provide bank-related services for you. And you're going to go to the one that gives you the best deal. So when banks have to start negotiating, they start having to cut fees, they start having to cut interest rates, it really squeezes their profitability. Let's see. Skip through some of this. Okay, these are some of the services that banks charge, and again, you don't use all of these services, but you know, things like currency exchange, making loans, offering deposits, safekeeping of valuables, supporting government activities, offering checking accounts, which are another name, demand deposits, and offering trust services. So banks tend to do a combination of these. And then you can kind of take a look at just some of the other things. So basically what all this shows is that banks do a lot. Now, this is in your table 1-1. I want you to mark this table in your book, if you would. And know when we talk about, for example, the intermediation role or the payments role or the guarantor role, know in general the differences between these. Okay, so table 1-1. These are pretty much self-explanatory in terms of what each one of them refers to. Now, the last part of Chapter 1 talks about banks creating money. So we're going to spend just a couple minutes on this, and then we'll take a short break. But it basically says, okay, how do banks create money? By granting credit, or in other words, making loans. And I will tell you, banks aren't, in the back room printing money. That's not how they make money. The U.S. government, they do print money. That's how they make money. But banks make money through granting loans. So this is how the process works. When you walk into a bank to borrow money for something, so let's say you're buying a car. You're going to sign what's called a promissory note. That means says you're going to pay the money back. And then typically the money is going to be deposited into your checking account. So let's say you're buying a $10,000 car. You get a $10,000 loan. You're going to write a check to the car dealer. And so they put the money, your loan officer simply deposits the money in your checking account. So you go to the car dealer, you write your $10,000 check, you now have a car. Well, what's going to happen is it says the customer would write a check for the amount for the item that they purchased, and then once they write a check to the car dealer is going to deposit that check into their checking account. Now, we mentioned this earlier. The United States has what's called a fractional reserve system. What that simply means is, for every dollar that's deposited, a bank has to keep a small fraction of that dollar on deposit, and the rest they can loan out. And this amount goes up and down based on what the Federal Reserve System is doing. But that's basically what this means. So they have to keep it in bulk cash or on deposit with the Federal Reserve Bank. Okay, so we've made a loan. You've written a check. The check has then gone into the car dealer's checking account. And so what happens when a loan is made is these deposits simply flow from bank to bank to bank. And with each deposit, a small percentage is held out, but then the bank can loan out the rest. And so what we have here is we can have what's called a money multiplier effect. You might have talked about this in some of your economics classes. But the amount of new money created is going to be equal to the amount of new deposits divided by RR plus L. RR is the reserve requirement. L stands for leakages, or simply part of the loan that you put in your pocket, for example, that you don't deposit. So what we've got here is, now again, keep in mind how this is working. You've got deposits that are made from a loan. The reserve requirement, so let's say the reserve requirement is, I think I've got an example on the next slide. Let's say it's 20%. That means they're going to hold out 20 cents. The other 80 cents is going to be then loaned out to somebody else. Now, these leakages, this is a problem. This is a problem for the money multiplier effect, because the more money you hold out of your checking account, the less the multiplier has an effect on the deposit. So, in taking a look at this formula, and this is our money multiplier, this is the actual 1 divided by reserve requirements plus L. If we start with the amount that a bank initially takes into deposits, divide this by the reserve requirement. So here's the example of the 20%. So for every, for example, the reserve requirement is 20% for every $100 a customer deposits into a bank. 20% of that, or $20, has to be kept in reserve. $80 can be loaned to other bank customers. So by making a loan and this money multiplier effect, banks actually increase the money circulating within the economy. And we can see that here. So here's our first deposit. 20% is kept out, $20 is kept out, $80 is then deposited. The car dealer would then write a check. They're going to keep 20% of that out, so they're going to keep out $16. It goes to another bank, $64 is loaned out, and this keeps going until eventually the money works its way out. And so what that means is as the banks keep lending, the $100 that's initially deposited creates a total of $500 in new money. new deposits. So when you talk in your economics classes about the Federal Reserve and how they can increase or decrease the money supply, and that's something that they're looking at really closely right now, because if there's too much money in the economy, what potentially can happen? Inflation. Okay, so there's too much money circulating, you can have inflation. If there's not enough money circulating in the economy can slow down and go into a recession. So when you talk about ways that the Federal Reserve can increase or decrease the money supply, this is one of the three major ways that the Federal Reserve can do that. They can increase or they can decrease the reserve requirement. Now, this is using 20%. The actual reserve requirement goes up and down fairly often. But typically, it depends on the size of the bank, it depends on the deposits of the bank, and normally it's about 10%. So a bank typically has to keep out 10 cents of every dollar that's deposited, the rest they can loan out. Now, for test purposes, you need to understand how this money multiplier process works. Okay, so I'll probably give you just some information of a new loan, a reserve requirement, possibly some leakages here, and I'll ask you simply to calculate how much new money can be created. And so again, you just follow this example. All right, and then finally, the last part of this, it talks about different career opportunities in Chapter 1. A lot of times we mistakenly think that when it comes to a bank, you know, we think about things like, well, if I work for a bank, I can become a loan officer. Or I can be a bank teller. Or I can be a customer service representative. But really, you know, what else is there at a bank? Well, there are thousands of different types of jobs. You know, you've got security analysts and traders that will work for a bank. You've got marketing personnel. You've got human resources managers, investment bankers, bank examiners and regulators. This is a huge, huge business. Compliance officers. So if any of you take the Finance 344, I think, the compliance management class, that's going to open up an entirely new world of job opportunities to you. Now, not everybody is meant to be a compliance officer. But if you're that kind of person, you can make a lot of money and you can find a job almost any place, because compliance is a huge part of banking. Risk management specialist. I just had a student come see me. I was up here working late last night, and he dropped in, and he just got a job as a risk management specialist at a local bank. And so what his job is he is the one who looks at loan applications, larger loan applications from typically businesses, to determine initially, is this a good loan or is it a bad loan? And then the loan officer would then take it from there and take it further. But this person's job is to mitigate the risk that the bank is taking. So, risk management specialist. And again, you know, loan officers, credit analysts, system analysts. If you're an IT person, so if you're good with technology and you understand banking, that field is exploding with jobs. Why are there so many jobs available in IT and in banks right now? How many data breaches do you read about each week where somebody's hacked into a system? They've stolen your personal information. They could have stolen your personal information. Happens all the time. The hackers are good. The IT specialists have to be just as good. Banks are going to pay you a lot of money to be better than the hackers, if that's you. Okay, it's not for everybody. But again, just lots and lots of jobs available. All right, so that is Chapter 1, kind of an introductory look at banking, bank careers, that type of thing. So let's take a break. Let's take about a 10-minute break. You come back, we'll jump into Chapter 2 just a little bit, but I'll still get you out of here plenty early tonight. might catch it. I don't think I have picture-in-picture here with this. What about that loss to Tennessee? Oh. Okay, let's go ahead and jump into chapter 2. We're just going to cover a small part of chapter 2. You'll notice when you get in your book, a lot of it simply talks about the different laws and regulations in banking. And I mean, there are lots of laws and regulations, but it kind of walks you through historically what's happened. And you can read that easier than I can sit up here and talk about it, okay? So I'm just going to let you take a look at that section on your own. But chapter 2 talks some about it. Chapter 3 kind of goes into a little bit of regulation. But basically, you know, it talks about why is banking so heavily regulated. And there's lots of different reasons for it. There are 3 pretty good reasons right here. So, you know, banks are heavily regulated to safeguard the public savings, to bring stability to the financial system, and to prevent abuse of financial service customers. You probably, I mean, and there's just multiple examples that you can use of each of these. Most of you probably heard about the Wells Fargo fiasco of last year, and they were essentially opening accounts in customers' names, but they didn't bother to tell the customers about it. And that was because a lot of the bank employees, their compensation was based on the number of new accounts that they opened. So if that's how you get paid or that's how you get a bonus, and you think you can get away with opening accounts in somebody's name and not telling them, well, they opened thousands of bank accounts. Problem is, they didn't tell the customers about it. And so that was, I mean, when you hear something like that, not only does it give banking a bad name, it gives bankers a bad name. And bankers, for years, they kind of had to fight that stereotype of, well, banks will loan you money only if you don't need to borrow money. So if you're wealthy, they'll make you a loan. If you really need a loan, they won't loan it to you. And you see the different Christmas movies of the evil bankers throwing people out of their house on Christmas Eve and all of that stuff. And that stereotype, you know, it kind of takes hold. And so if you take a look at certain surveys, bankers can be the most trusted people in somebody's life, or a banker can be one of the least trusted people in a person's life. And I will say, you know, if you've got a good financial institution and a good banker that you can trust, that person is going to be right up there in your life, right with an attorney, a really good attorney. So in your life, in your business and personal financial lives, you need a good attorney, you need a good accountant, you need a good banker, and what else would you say is necessary? Insurance agent will be good. Yeah, I mean, there's going to be about 5 key people in your life that they're going to take care of 95% of your financial issues. And that's why when you when you talk to bankers and you talk to people who have been in banking for a while, especially loan officers create money for the bank. So they make loans, and those loans result in interest income for the bank. If you are a good loan officer and you have a very loyal customer base, you can go just about anywhere you want and make about as much money as you want, because other banks are willing to pay you to work for them because you already have a nice, stable customer base in place. And just like with a doctor, if you've got a doctor that you like or a dentist, you'll probably follow that doctor just about anywhere reasonable. If they leave practice here in Murray and they go to Mayfield, you'll go to Mayfield to see that doctor. Or if they go to Paducah, you'll drive to Paducah to see that doctor. Well, with loan officers, especially commercial loan officers, the ones who make loans to businesses, if they go anywhere within a 60 to 70, 80-mile radius, their customers are going to follow. And banks know this, so they're willing to pay premium salaries to commercial loan officers who have a current book of loans. And that might be anywhere from $15 to $50 million in loans. So if you've got that many loans that you've made, and you can take those customers with you to your new job, you can make a lot of money doing that. So these three items, of course, by themselves will be a good reason to make sure that banks are doing what they're supposed to. Tells us here financial institutions must contend with some of the heaviest and most comprehensive rules applied to any industry. And if you talk to bankers, and I talk to a lot of bankers every year. I teach at a couple of banking schools. One is in Memphis, one is at LSU. So I have access to about 900 bank professionals every year that I talk to. The one thing that they all complain is not really the right word. The one thing that they're all concerned about going forward in banking is bank regulation. Now, there may be other things that each of them in their little different cliques may worry about, but they're all concerned with regulation. And they all will tell you regulation gets in our way of making money. And that's consistent. Whether you're in Kentucky, Tennessee, Washington State, California, Washington, D.C., Maine. We have a lot of bankers from Mexico who come to these banking schools. It's the same way in Mexico, although not quite to the extent. We have about 50 bankers from Mexico that come up each year, and they will tell you also that regulation, it's just a pain. It's burdensome. It costs a lot of money. I mentioned to you earlier about the local bank here paying $1 million a year just to keep up with regulations. And it's also damaging to innovation and efficiency. Because, you may want to try something different. You're thinking, hey, we can offer a new product to our customers. But if it's outside of the regulatory reins of what you can do, then you simply can't do that. And as you go through this chapter, you'll see how much banking has changed and kind of, why they're closely regulated. And again, this is all common sense in terms of banking. Banks have a long history of involvement with federal, state, and local governments. Banks, where we put our money, they have the ability to create money. We talked about that earlier. And so, in the United States, and you need to know this, okay, for purposes of the first test, we have what's called a dual banking system. And that's a little different than other countries. What this means is a dual banking system. That means that we have federal government regulations and state government regulations that we have to contend with as a bank. So federal regulatory and state regulatory issues. Now, you may look at that and think, well, okay, that's fairly common. There are other industries that have to deal with federal and state regulations. and that is true. But the problem is, often occurs when a bank's not really sure whose regulations do they follow if they conflict. A perfect example of this, and something it's a problem, it's been a problem, and it's going to be a problem into the foreseeable future, are states that allow recreational marijuana sales. Because recreational marijuana sales are basically an all-cash business. The reason is there are federal laws against the sale of marijuana. And if a bank is federally regulated, they cannot legally open an account for a business that sells recreational marijuana. So they've got this huge amount of cash coming into their business, literally billions of dollars in cash. And they have nothing to do with that money. Banks won't take it. Banks legally can't touch it. And so what tends to happen is the businesses will open an account at first, and they'll run their business just like any other business through the bank until the bank figures out what they're doing and what business they're in. Then they shut them down. They'll try to open up a different account, and they'll typically go through most banks within their operating area until eventually everybody knows what they do, and they simply have to go on a cash-only basis. Now, most of us don't have the problem of having a room half this size full of bundles of cash, legal cash. I mean, you've seen it in the movies where the illegal drug dealers have cash, everywhere, but these are legal entities. Under state law, they're completely legal. Under federal law, they're completely illegal. And if a bank opens an account for them, then there are severe penalties. It's just like you were money laundering for a cocaine dealer out of Mexico. It's the same thing. And so this is where this dual banking system, there's a big problem here for certain type of industries. And that's becoming more prevalent. It was Colorado. And it was Washington State. And it's, Maine and probably 2 or 3 other states. And so that's something that was a small Colorado problem at one time. Now it's growing to be a much bigger problem. Because not only do you have to worry about cash, but also the safekeeping of that cash. And when you're dealing with cash transactions, as those of you who work for a bank know, if you have a cash transaction over $10,000, you have something called a CTR that you have to fill out. You know how long it takes a recreational marijuana business to generate $10,000 in cash? An hour, less than an hour. So they've got all of this money, and there's nothing to do with it. So it's kind of a situation where you're too successful, you've got too much cash on hand, and there's really nothing legally that you can do with it. Now, when it comes to our dual banking system, this is basically how it's going to work. The first thing that you do if you want to open a bank is you have to come up with what's called a charter of incorporation. You have to decide, do I want a state charter, which would be issued by the state in which I operate, so Kentucky, Tennessee, whatever, or do I want a national charter? National charters are issued by the Office of the Comptroller of the Currency, or I abbreviate often, just simply say the OCC. So you get a charter. Now, whenever you apply for a charter, the regulators, whoever it is, they do very thorough background checks on you, any potential employees, any potential board members. Why would they want to do such thorough background checks? Why can't anybody just open a bank if they want to? It's pretty simple. If we want to open a bank, let's say I want to open a bank and I see a need in a certain area, I have to get together some investors, have to get together some capital. It's going to be anywhere from probably, if I want to open a bank in Murray, it's probably going to take $10 to $15 million in capital. If I want to open a bank in Nashville, for example, it's probably going to take 30 to 40 million in capital. But why would they be concerned if I wanted to open a bank? Now, we just talked about drug sales and illegal drug dealers especially having trouble laundering their money. So what better way to launder your money than to open your own bank? It's a fantastic idea. The problem is these people are supposed to make sure it doesn't happen. You don't want drug dealers having their own banks. You don't want organized crime having their own banks. So they're going to do a lot of background checks. They're going to do thorough background checks. Part of my job, one of my jobs with the Office of the Comptroller of the Currency was when there was a charter of incorporation, a national charter of incorporation, then I would do background checks on the people opening the bank. And it's amazing the stuff that you find out when you start kind of snooping through their background legally. There's a lot of people that are involved in things that I guess they just thought nobody was going to check. But you find out pretty quickly this is not the person you want owning a bank or operating a bank. Okay? So you get your charter from corporation. You're going to go either state or national. Now, if you decide to become a state chartered bank, your charter would be issued by the state banking authority. Now, a couple of things here. You need to know this for the first test, okay? It's really important. State charter banks are not required to join the Federal Reserve banking system. So when I say Fed, I'm talking about the Federal Reserve banking system. So state charter banks are not required to join the Fed, and most of them don't join the Fed. The reason is it's expensive to be a member of the Federal Reserve banking system. And most state charter banks, they're not all small, but most of them tend to be your smaller community type banks. And they can get all of the services that they could get from the Fed from what's called a correspondent bank. And so why join the Fed if you don't have to? So most of them don't. And also one thing that some people think is kind of strange, but if you're a state chartered bank, you are not required legally to obtain FDIC insurance. Although most people think that all banks are FDIC insured, and as a matter of fact, about 99.5% of all banks are FDIC insured, but there are some out there that aren't. Now, they have to have some type of deposit insurance, but it doesn't have to be FDIC insurance. Now, this is with a state charter. If you want to be a national charter, these tend to be larger banks. If you're going to be a nationally chartered bank, you have to join the Federal Reserve. You don't have a choice. Okay, like I said, it's fairly expensive. You have to buy stock in the Federal Reserve Bank. The fees, the annual fees are fairly expensive. But if you're a large enough bank and you actually have to be typically around $1 billion or more in assets for it to pay off, then you join the Fed. And you have to, since you're a member of the Fed, you have to obtain FDIC insurance. And here's a question for you. When we talk about FDIC insurance, who pays the FDIC insurance premiums? Because somebody has to. So who pays for that insurance? Who? It's not the Federal Reserve System. Okay? Banks pay for it, okay? And banks pay for it through charging essentially their depositors. Because if they didn't have to pay FDIC insurance premiums, they could pay you a little bit more in terms of interest. So they pay you a little bit less interest on your deposit. Banks pay FDIC insurance premiums. Okay, so when people, you hear a lot of times on the news, you hear them mistakenly referring to banks being bailed out by the FDIC insurance, their insurance reserves. Well, actually, they're the ones paying for it, so they're not really being bailed out by that. They paid the insurance premiums themselves. So it's similar to you having a car, you're paying the insurance premiums. If you wreck the car, nobody's bailing you out. Your insurance premiums that you paid are taking care of that problem. It's the same way with FDIC insurance. Now, once you've got your charter and you're running your bank, there may be a combination of regulators who take a look at your bank to make sure that it's safe and sound. So that's one area of regulation, safety and soundness. That looks basically at the financial aspects of a bank. And then you have the compliance area of a bank. And they're the ones who are looking at the rules and regulations to make sure that your bank is complying with all the state and federal rules and regulations. So this is just kind of a cheat sheet of who does what when it comes to regulations. And I could pretty much guarantee you could probably go out there and ask 90 bankers who've been in the business for 10 years who regulates what in the banking industry. You ask 100, 90 of them won't know who does what because it's literally so confusing. So this is kind of a really good cheat sheet for this. The Office of the Comptroller of the Currency, they regulate all nationally chartered banks. So if a bank has the word national in the name, First National Bank of Murray, or if they have the letters NA after the name. NA stands for National Affiliation. So it could be the First Security Bank of Mayfield, NA. They got the letters NA after it. That's for National Affiliation. That means they're a nationally chartered bank. The Federal Deposit Insurance Corporation, the FDIC, they regulate state-chartered banks that aren't members of the Federal Reserve that have FDIC insurance. FDIC, state-chartered banks that are not members of the Federal Reserve but do have FDIC insurance. So that's basically almost all state-chartered banks. Okay, the state banking authorities. State of Kentucky, state of Tennessee, state of Missouri, whatever. They regulate all state-chartered banks. And then we've got the Federal Reserve System. They regulate state-chartered banks that are members of the Federal Reserve and also bank holding companies, which we'll talk about bank holding companies a little bit later. So the Fed, state-chartered members of the Federal Reserve, and bank holding companies. So you can see here pretty easily that more than one of these regulators can regulate the same bank. And this is one thing that drives banks crazy is, you know, let's say, for example, they've had the FDIC in for 3 weeks, going through everything in the bank and asking questions and taking up a lot of the bankers' time. And once they leave, then the state might walk in and stay for another 3 weeks, asking questions, asking for material that you just got for the FDIC, whatever. And so they're looking at this going, this just seems like too much regulation. Or you might have the OCC in a bank, and then you've got the Federal Reserve at the same bank, but they're examining the holding company portion of the bank instead of the bank itself. So again, just layers and layers of regulation, but you need to know who regulates what. Okay, extremely important. All right, a lot of this other stuff I'm going to let you just kind of take a look. Let's just kind of go through some of these slides. This kind of is a more comprehensive list of what I have here. Okay, I just kind of went through here and simplified it for you into this slide. This, one of the terms here, and you might want to just mark this term here at the bottom of the page, it's called something called a regulatory dialectic. And what this is referring to is simply the ongoing battle between banks and regulators. And it's really just a game, okay? It's a cat and mouse game. This is the regulatory dialectic is simply saying that banks are always looking for ways around rules and regulations, so legal ways around rules and regulations. Then the regulators will come in, they will close that loophole, and then banks start looking for another way around the rules and regulations. And so you've got this constant cat and mouse game of one of them finding a way around it, then they come in and close it, then they find a way around it. And again, it takes some really intelligent people to play this game. So that's why, in addition to just bankers, banks rely heavily on accountants and also attorneys to find ways around this. So you need to know what the term regulatory dialectic represents. And then this is just going to be a listing of some of the bank laws and regulations, and you can just take a look at this in the book yourself and also the slides. So things like the National Currency and Bank Act of 1863. This actually created the Office of the Comptroller of the Currency. Most people don't know that the Office of the Comptroller of the Currency is a branch of the United States Treasury Department. And so the United States Secret Service and the OCC, they work closely together in terms of looking, for example, at counterfeiting. The Secret Service is actually in charge of counterfeiting investigations. You've got the Federal Reserve Act of 1913 that created a central banking system. Before that, we did not have an effective central banking system. You've got, this has a couple names. You need to know both names for it. The Banking Act of 1933 is also called the Glass-Steagall Act. And it's basically, it went in and separated commercial banks from investment banks. Because before this time, you know what investment banks do, okay? They help corporations raise stock and bonds. And you had commercial banks that do what we think of as a normal bank, what they do. Before this time, they could be the same company. And so can you kind of see a conflict of interest if an investment bank is trying to raise capital for a corporation and they have access to deposit money from depositors? You can see how that could be manipulated pretty easily. And so that's what separated these two functions. Then you've got the, it's called the FDICA, FDICA, the FDIC Improvement Act of 1991. Then you've got other, there's just a never-ending supply of these. You've got the Consumer Credit Protection Act, also known as Truth in Lending. You've got the Dodd-Frank Regulatory Reform Bill. You've got the Equal Credit Opportunity Act. Now, this is kind of an interesting, because when you get to some of these rules and regulations, some of this that seems to make common sense actually doesn't. For example, tell me if this is legal or illegal. Let's say that I'm a mortgage loan officer. I have a little old lady walk into my office. She is 92 years old. She wants to take out a 30-year mortgage to buy a condominium in Florida. She's got a good enough credit score. She's got the income to make the payments. Do I have to legally make her that loan? She's 92. She's taking out a 30-year mortgage. Can I simply say, ma'am, I'm sorry. There's no way you're going to make it to the end of this loan. Okay, I don't want to be stuck having to deal with this. Do I have to make her the loan? I see some of you shaking your head no, some of you shaking your head yes. Okay, legally, I have to make her that loan. Do what? I can't discriminate based on age. If she shows that she can make the payments and that she meets our credit criteria, I have to make her the loan, knowing that her estate is going to be the one handling that, and I'm probably, that's going to be a mess probably. What about this? Let's say that I'm a loan officer and a young couple comes in. They want to buy a house. So they're a young couple, man and wife. The young lady is visibly very, very pregnant. Together, they both work. Together, both of their loans meet the minimum income to loan payment criteria. By themselves, neither one of them meet the minimum criteria. Can I legally ask that couple, or that young lady specifically, if she plans on staying at home with her children after they're born? Because if she does, I can't make them the loan because they're not going to qualify. But if she plans on working after the child is born, then I can make them the loan. So can I legally ask her that question? And it's a simple question. You plan on staying home with your kids when they're born? Some of you are looking like, no, you can't. A couple people have said, yes, you can. Some of you are looking like, I don't really want to get into this situation ever. Okay. The answer is yes and no. No, I cannot say, do you plan on staying at home with your children after your child is born? I can legally ask, do you see any disruptions in your current level of income over the lifetime of this loan? So if it's a 15-year loan, 30-year loan, whatever, I can ask, do you see any disruptions in the income? So that's a nice way of saying, do you plan on working after your child is born? One is legal. Okay? One can get you a nice fat lawsuit, discrimination lawsuit. And that's why when it comes to banking, being able to document all of this stuff and being able to document everything that you're doing is really, really important. Okay? What if I have somebody that comes in Okay, what if I have somebody that comes in and wants to borrow money? They're not, okay, so they're not native to the United States. They are very clearly, they give me their information, permanent address. It is clearly a Muslim country. A pretty touchy subject right now. And, you know, what if I'm not sure that they're even going to be able to stay here for the next 4 years with everything we've got going on? Can I deny them a loan based simply on the country of their origin? Even though I might make them the loan and they might be legally kicked out of the United States with the bank's money next week. Can I deny them credit? No. Okay? And this is, I mean, these are things that for years, nobody paid any attention to this. It was common to have very, very discriminatory lending laws, and people just kind of looked the other way. I mean, it was common. I mean, even when I was a bank regulator, you would go into the back room of a bank. Okay, this is not red, this is orange. But you might have so let's say that this is the bank's lending area. This is a map, okay, a geographic map. And so they've got a big map on the wall in the back room, like on the door. And there might be certain streets that I've just taken and I've sectioned off. And I've just got, you know, something like this in this part of the town or the county or the service area. This is what's called redlining. In redlining, I'm orange lining, but redlining, simply meant that there might be a part of the town or the part of the service area that the bank serves that maybe it's lower income, maybe it's a minority community, maybe property values aren't really what they should be and what they are. And so the bank simply goes through and says, if somebody comes in with an address that falls within this area, you accept their application and you turn them down for the loan. We are not going to make a loan that falls within this geographic area. And that was common. I mean, I went into banks and I would go into the back room and you would see the map and you would see the outline of the area where they would not make loans. This was 20 years ago. Okay, this wasn't the 1950s. This was 1990s. And it was still happening. And banks didn't see anything wrong with it. So you had to kind of convince them through various penalties, including what's called CMPs or civil money penalties. You had to convince them this is not legal. You can't do this. You can't deny somebody a loan based on where they live or their national origin or their sex or their race or whatever, their age. And some are pretty straightforward and pretty simple. Others, like the 92-year-old woman who wants a 30-year home mortgage, that's a little more difficult. So again, lots and lots of different types of laws. Let's see if it mentions it here. Okay, yeah. This one, the CRA, the Community Reinvestment Act. It says this prohibits banks from discriminating against customers residing within their trade territories merely on the basis of the neighborhood in which they live. What this means is, and a lot of banks get caught up with this. Let's say that I'm a bank operating in southern Florida. Within my area, there is a large Latino community. What the Community Reinvestment Act says is, if I take out newspaper advertisements in just a general newspaper, if there is a Spanish language newspaper serving that area, I'll also have to take out ads in that paper. Because if I don't, I am discriminating against the Latin community, whether it's newspapers, radio ads, television ads, whatever. If I'm advertising in one form of media based on the English language and there is a sizable community of non-native language speakers, I have to advertise to them just as much. If not, it's illegal. If my bank has a branch in a certain area of town, let's say it's a terrible area of town, lots of crime, lots of unemployment, I can't simply, as a bank, go in and shut that branch down because it's not making money. Because if it is the access that that area has to banking services, I have to keep it open so they have equal access to banking services just like other customers in other parts of my service area. Or if you're going to open a branch, you have to do the same thing. You have to make sure that you're serving everybody equally. And this is actually one of the things, for example, the safety and soundness rating, which we'll talk about that later. Nobody knows what that is. Okay, that's proprietary information. Just senior management of the bank and regulators know what that is. But the Community Reinvestment Act, you can walk into your bank tomorrow and you can say, I would like to see a copy of the last CRA exam. They have to show it to you. They better be able to put their hands on it really quickly. Because if not, again, that's against the law. They have to show you that. So this is one of the few things that you can actually see how your bank is doing. And then just other things, Competitive Equality in Banking Act, Truth in Savings. There's just an unending amount of regulations. This shows you kind of what's happening with banks and what's happened over the last several years with banks. went through a time period where there were lots of banks closing. I mean, hundreds of banks closed. As a matter of fact, since 2008, there have been over 500 banks fail in the United States. Go out of business because they made such bad decisions. And so you can see kind of what's happening here. What you have, and these numbers really haven't changed a lot, that's why I haven't updated it. You've got a lot of small banks, thousands of small banks, who control a small amount of money. You've got very few large banks that control the majority of money in the United States. Now, this is a little bit different because if you take a look at this, you take a look at the number of banks operating, so we've got about 5,800 banks operating in the United States. Do other countries, and it can be Asian countries, European countries, do other countries have as many banks as we do? And some of you might have traveled internationally. I've got some international students in here. Do you have a lot of banks in your country, or do you have a few banks, but they're really big? Okay, you've got a few banks, but they're really, really large. The United States model for banking goes against everything else around the world. Because if you look at it, it's actually a really, really inefficient way to have a banking system. If you have a small bank that's got $40 million in assets, and there are banks that have $40 million in assets, that is a tiny, tiny bank. But in the United States, we're okay with that. In Japan, they've got safety deposit boxes bigger than $40 million. I mean, it's not a very efficient way to run a banking system, but we're spoiled. If you think to your grandparents, maybe even your parents to some extent, a lot of you, especially if you're from a smaller town, the bank it's not just a bank. It's a form of socializing. You go into the bank, and you probably don't, okay? But your grandparents might. They go in there, they see the same people every time they go. They ask about their family. They find out what's happening in the community. It's a form of socializing. Your parents, maybe not as much. Maybe they don't do that as much. You certainly don't do that. You're doing your banking online, most of you. Online banking, sometimes you're using ATM machines, you're using night deposits. Some of you will go into the bank, not very many of you will. I'd say out of this class of 40 people, probably 10% of you go into your bank on a regular basis. The rest bank some other way. So you're starting to see a change, but guess who has all the money to deposit right now? Is it you? No, it's your parents and your grandparents. And if that's what keeps them happy, brick and mortar, small, inefficient banks, that's what we're going to have. And people have been saying, since I was sitting where you are in college, that in the next 5 years, you're going to see almost all banks consolidate. They've been saying that since I was a junior in college. Next 5 years, you're going to have all these small banks. They're going to consolidate, and we're just going to be left with 20 or 30 really big banks. It hasn't happened since then. It's not going to happen in the next 5 or 10 years. Okay? It might at some point, but it's going to be a ways down the road. Okay, so some more banking laws. This one actually, it was kind of strange. Before 1994, banks could not operate outside of state lines. So if you're a bank in Murray and you wanted to open a branch in Paris, Tennessee, you legally could not do that. I mean, that was really, really odd. And if you went to some states, for example, the state of Illinois has some really, really strange banking laws. They're archaic, they're out of date, but they're still on the books and they're still legal. For example, if you go to Illinois, if you've ever how many people in here from Illinois? A few of you? Okay, Illinois has lots of little, what they call villages, okay? And you might have a village that has 400 people in it. But I'll almost bet you it has a bank. And a lot of times it's an independently owned, it's not a branch, it's an independently owned bank. And that's due to some of the archaic laws that Illinois has on the books in terms of how close banks can be to one another. They had laws on how close banks could be to railroad tracks and school systems and post offices, and just a really odd assortment of laws and regulations. So Illinois, in terms of the number of banks they have a lot of banks. They've got more banks than Japan does in terms of independently owned banks. The state of Texas was very similar. They have a lot of independently owned banks. But then once this came into effect and it opened up state lines, then banks just went crazy. I mean, they've been chomping at the bit for years to open up a bank across a state line. Now they can. So they started buying up all these competitors. Why build a bank in Paris when I can simply buy a bank that's operating there and simply put my name on it? And so you had banks buying up banks. They were paying 2 to 2.5 times book value. And in the mid to late 90s, you had independently owned banks or family-owned banks that people thought would never sell, selling fast, because the people running the bank, they were in their late 50s, early 60s, late 60s. Somebody's offering them 2.5 times book value for their bank. Man, that's a no-brainer. I'm selling, I'm moving to Florida. And so that's what happened to hundreds and hundreds of banks. It just went crazy. People paying outrageous prices. It took about 3 or 4 years, 5 years, in the early 2000s. They took a look around at the buying spree that they went on, and they said, what the hell were we thinking? They were just trying to buy a bank before their competition bought the same bank. Not really trying to figure out how does it fit geographically within our service area. And so, for example, I was working for a bank that bought out the bank that I was working for. Their headquarters was 4 hours away. So if they wanted you to come to headquarters for a meeting, it took up a day. Your day was gone. You'd leave at 6 in the morning. You'd get there about 10 o'clock. You'd have an hour meeting. You'd eat lunch. You'd drive back home. Your day was shot. Now, does that sound very efficient? It was stupid. It was one of the most ignorant things, and it lasted for about 3 years until the headquarters decided, you know what, that bank that we bought way out in BFE, that's just not going to work for us. We're going to sell it to somebody that it makes more sense. So then you had, in the early 2000s, you had another wave of reorganization that made a little more sense. But again, it's simply because of these laws and regulations that were passed. And then you go into, 1999, and one that's actually not, now this one, the Patriot Act, this is actually a pretty important one. Any of you who have taken Finance 350 or will take Finance 350, which is a counter-threat terrorism class, you're going to study a lot about the Patriot Act and ways that organized crime and terrorist organizations move money from one country to another country. Because it can be a really, really sophisticated process. And so the guy who teaches this, he actually teaches Special Forces military units how to follow money trails. So he'll teach, for example, Navy SEALs or Army Rangers, if they're in Afghanistan and they find a laptop computer and some cash, they can trace that money back to originating in a bank in Murray, Kentucky that was then sent overseas to help finance terrorist activity. So that's what a lot of this is concerned with. And then one of the final acts that's not, I mean, there's some other ones there. You've got just all kinds of different rules and regulations. What I want you to know from Chapter 2, and let me just kind of simplify this, is if you take a look at the study guide that's in Canvas and you take a look at the laws and regulations that are mentioned, those are the ones that I want you to focus in on. Okay? And so, you know, the big ones here, like the Patriot Act, the Financial Services Modernization Act, which is also called the Graham-Leach-Bliley Act. You know, these big ones, I want you to know in general what they do. You don't have to know everything about them, just in general what they're trying to accomplish. And then one of the last huge areas of, let me run through some of this. This is talking about the Federal Reserve System, where, I mean, you've talked about that in other classes, so don't worry about that Federal Reserve System portion. One of the last huge pieces of legislation that went through was the Dodd-Frank Act. And this is probably one of the most recent things that bankers are worried about, because the Dodd-Frank Act was literally thousands of pages of regulation that banks are looking at thinking, okay, how are we going to comply with all of this? And the way it works is typically they normally roll it in terms of different levels, and so they may, you know, have a 5-year phase-in period for the entire act. But it's something that bankers have really been worried about now, with possibly deregulation hitting, which this is kind of common, that we go through periods of deregulation, then more regulation, then deregulation, then more regulation. They're expecting the next few years to have less regulation, so maybe they'll get some relief from the Dodd-Frank Act. But if you're in banking, one thing that you can count on is always going to be changing. And that's good for you, because that means there's always going to be jobs available in that industry. All right, so are there any questions about Chapter 1 or Chapter 2 before I get you out of here for the night? Now, I promise you, all semester, we're not going to talk about regulations, okay? It gets better. It's just the first part of this. We've got to kind of wade through this. Be sure next week, be sure to bring a calculator with you, okay? We're going to look at some bank financial statements. We're going to do some calculations, and we're going to get into kind of the meat of the banking industry. So everybody have a great week. Be reading Chapter 3, 5, and 6 for next week. I'll see you next Tuesday night.